This is the third component of the Indian financial system. We have completed the top two: financial assets, financial services we have completed. Today we'll be beginning the third component, financial markets. Let's look at the meaning of financial market. It is a mechanism which facilitates the transfer of resources from one entity to another. It facilitates the exchange of financial instruments like shares, debentures, etc. The existence of a dynamic and resilient market is an important requisite for the development of economy. Now, all of us have come across what is a financial market, trading, stockbroker, etc. Now, when we are looking at the meaning or why is this financial market coming into existence, let's remember this word: to facilitate the transfer of resources. The first line, if you can note there, facilitate the transfer of resources from one entity to another. Here, entity means either it can be an individual, a firm, a sole proprietor, an organization, or an institution. Got it? It can be any entity for that sake. What does market do, or why is it existent? To facilitate the transfer of resources. What kind of resources? Shares, debentures, etc. All these are called as financial instrument. Just last class we discussed what is a financial asset or instrument, right? Now all those instruments, where is it getting traded or where is it getting exchanged as a resource, is this platform called as financial markets. The existence of a dynamic and resilient market. Let's break down that sentence. The existence means the existence or the very establishment of this financial market. What is the importance is it has to be dynamic. Anything that constantly changes, right, is called as dynamic, changing every day, updating towards the changes in the market or changes in the economy. That means it is dynamic. What is resilient means overcoming. Resilient means with facing the challenges in the most positive way and coming back or overcoming the issues or the problems in the economy. Understand? How should a financial market be? It must be dynamic and it should be resilient. Market is an important requisite. If our economy from underdeveloped India to what it has become as developing India today, one of the fastest growing nations, right? What is the backbone is? One of the backbone is financial markets. So the very existence of the financial market will develop our economy. There are various markets here. For an example, stock market, bond market, derivative market, commodities market. What is traded in stock market? That is what is common that you guys see in National Stock Exchange, Bombay Stock Exchange, right? Shares of different companies who are listed on the exchanges are being traded. What is bond market? Where your debentures are being bought and sold. Only debentures. That is called as bond market. What is derivative market? If you are exchanged or if you are an exporter, if you are an importer and you want to have trade relationship with the other countries. So if you are exporting, you have to receive money in terms of rupees. If you are importing goods from another country, you have to pay money in their respective currencies. And remember, this currency, that is how much of $1 is equals to how much of Indian rupees. This value of rupees or currency keeps fluctuating every single day. Got it? Keeps fluctuating every single day. So sometimes it may end up in losses that trade or in terms of profit. All depends on the valuation of this currency. In order to avoid that currency fluctuation, you can enter into the derivative market. There you have lot of contracts, right? Forward contract, future contracts, or there is options, there is swaps. All these deal with a predetermined trade relationship only based on the prefixed currency or a prefixed price at which you will import or at which you will export. The final one is commodities market, where you sell all your household items like rice, ragi, jowar, all these, essential field agricultural items, whatever you sell, that comes under the last category called as commodities market. So all put together, stock market, bond market, derivative market, commodities market, all put together, financial market makes it the most important or one of the backbone that develops our economy. Hope you have understood the meaning of financial market here. Let's look at the next main important topic, features. What are the characteristics or features of financial markets? The first one is acts as a link. Link is nothing but the person who connects two poles, right? The person who connects two poles or two different entities. So financial markets, what do they connect? They connect investors to the borrowers and bridge the gap between the two for mutual benefits. Now let's say for example your stock market, right? Now stock market where you buy and sell shares. You are buying or investing your money into the shares. For what motive, for what objective? Because you can earn a return on it, correct? You can earn a percentage of dividend on your equity shares. From the other point of view, why is the company giving you equity shares? Because they need equity share capital. Understand? So you are the investor and the company is the borrower in terms of stock market. So what is financial market doing here? What is its role? Financial market acts as a link that connects you as a investor and connects on the other side the borrower, that is the company or organization. So it's going to bridge that gap and make you both connect. The money flow will flow through you and reach the company. Second, price determination. The financial market performs the function of price discovery. Notice that word, price discovery, of the different financial instruments which are traded between the buyers and the sellers on the financial market. So I asked you to notice that word, price discovery of what? Financial instruments. So just last class we discussed about financial assets or instruments, correct? Now there was marketable securities, there was non-marketable securities, there was debt asset, stock asset, cash asset, etc. Now all these financial instruments are going to be traded, and how was the price discovered is the market will discover the price based on the demand and supply of the instruments. Okay, how many investors would like to invest in a particular industry? Now if you are interested in pharmaceutical industry, okay, you are interested to invest in pharmaceutical industry, so many people would be moving towards the demand in pharmaceutical industry shares. So automatically the share prices of that particular industry will increase, or it become more day by day. On the other side, telecommunication industry, automobile industry. Now here, as industries, the price determination or the price discovery solely depends upon what? The demand and supply of the companies. Now even during this lockdown, if you have read the news, even though many companies lost their market share or their business in the markets or industries, Reliance was one such company which even still in the quarter 4 reported profits. If you have just come across, it has still reported profits. So that was really something that has to be appreciated. In terms the entire economy is having a financial crisis, there's not much business, etc. This one company actually outstood or was able to survive itself during this whole crisis. So there was still demand for the shares or the share prices of this particular company. Hope you have understood the act as a link, the first point, and the second point, price determination. Third, liquidity. Liquidity is what? In simple terms, the ability of an instrument to convert itself into liquid cash or an immediate currency. The market provides an opportunity for the investors to sell their financial instruments at its fair value, prevailing in the market at any time during the working hours of the market. Now, if you are into a stock market, again, there's no particular restriction, right? You have to hold the equity shares for 1 year or for 1 month or for 5 years. There's absolutely no restrictions even in selling the same. You have to sell within 2 years or you have to sell within 2 months. There's no restrictions. Liquidity means because of financial market and thanks to the technology, thanks to the information available, we have the opportunity or the availability of selling the equity shares and converting them quickly into liquid cash. So one of the prominent feature of market or financial markets is it enables easy liquidity for the investors. You have bought some 10 shares of a particular company last month and you immediately today want to you want some cash. There's an emergency, you can immediately sell it off in the stock market and get back all your investments. So that means without much hesitance, without much difficulty, without much formalities, you can convert that equity share certificates into liquid cash. Fourth point, risk sharing. The market performs the function of the risk sharing as the person who is undertaking the investments are different. Persons who are undertaking the investments are different from the persons who are investing their fund in those investments. Right? Here, in this example, stock market, you are an investor, you might be an individual, you might even be a student in this case, an employee, a retired person, etc. On the other side, the companies might be a sole proprietor company, a startup company or a multinational company, right? There's absolutely these two people are different. People who are investing the money are completely different from the people who are borrowing the same money. Therefore, the risk is getting shared. Now, there's absolutely no compulsion. You as an investor, nobody can dictate to you, you have to invest in this particular company. You have to invest in this particular share market or industry. No, risk is shared among the industries. So, let's say for an example, if you have rupees 1 lakh in your hand, okay, and you would like, this is your savings and you would like to invest into various investment opportunities to earn interest or to earn return. So this entire 1 lakh, because stock market is booming or particular company is having good amount of super profits, if you put entire 1 lakh into that company, who knows, then the very next day or in a couple of days, the company goes bankrupt. Correct? Or the company goes insolvent, or let's say the company is given statement by the court as a fraudulent company. All your money is gone, right? All your 1 lakh rupees investment is completely at loss. Instead, financial market will help you, since there is bond, there's commodity market, there's stock market, there's so many investment options. That same 1 lakh rupees, if you can invest, let's say 20,000 into fixed deposit, okay, another 30,000 in, let's say, government bond, another 30,000 in stock market, another 20,000 in bond market. Let's say this is your ratio in investing of rupees 1 lakh. That time, even if one of the company turns out to be what? Fraudulent or bankrupt or ended up in loss, okay, that 30,000 where you put into stock market is a complete loss. Have you lost 1 lakh rupees here? No, you have only lost 30,000 rupees here. Understood? So the rest of the 70% is in your hand. How can you do it? Because you shared the risk in different investment avenues. If the same money you put into one particular investment avenue, yes, if it's a profitable, you will earn double the money. If it's a loss, everything is gone. But if you're going to spread that investment amount or spread that risk over the investment avenues like bank deposit, bond, that is government bond, or derivative market or stock market, etc. If you can divide this investment into avenues, then your risk will be shared. So it is good perspective from a investor's point of view. Yes, you have lost a part of your investment, but you have a backup of 70,000 rupees in hand. Hope you have understood the third point, liquidity, and the fourth point, risk sharing. Fifth point is called as capital formation. Financial markets provide the channel through which the new savings of the investors flow in the country, which aid in the capital formation of the country. Now, even if it's a bond market, right? Now, let's go to the bond market. You have purchased the bonds of government. Government bond certificates are there, right? Now, if you're going to purchase or invest money into the bond market, where is the money going is the question, right? Now, government is going to collect. Likewise, you as one particular investor, there are going to be 1,000 other people or another 10,000 other people who are going to purchase bond or invest in bond market. Then this all savings that you have earned or invested in bond market will turn into capital for the government. Understand? All the taxes that the government collects, where does it go? For the development of the economy. Likewise, all the investment you make in the financial markets, either it can be stock market, either it can be bond market, derivative market, or commodities market. Any of this four, when you invest, it in turn becomes capital for the government or capital formation for the government. If you can say, I'm investing in shares of the company, ma'am, how can that be as a capital for the government? Correct. Now, once you have invested in the stock market, okay, that money is going for the company. Company is going to make use of that money and be productive in terms of products and services. That product and services, where is it reaching? Indian market, to the Indian consumers. So, basically, it is serving back the society or serving back Indian society. So, the company is just a route map or a trade map for which again it comes back as a form of product or comes back in the form of a service serving the citizens of the country. Understood? It might not be directly government or indirectly also it can serve as a capital formation. Point 6. Easy access. The industries require the investors for raising of funds. Remember this? Industries require whom? Investors. For what? Raising of funds. And the investors require what? Industries for investing its money. For what reason? And earning the returns from them. So, the financial market platform provides the potential buyer and seller easily, which helps them in saving their time and money in finding the potential buyer and seller. Let's say for an example, there is no financial markets. Okay, for a moment, let's assume that there is absolutely no financial markets existed in our country. Now, if you are a businessman, okay, or if one of you are an investor, businessman needs money, investor is ready to invest money. How can you both connect with each other? Let's say both of you live in different parts of the country. Is it very easy to reach? No, right? It takes lot of effort. It takes lot of research to find out who is the right investor. Is it right to invest within this company, etc. Because the investor will also be anxious about his money. He is putting his hard-earned savings. He wants to know how your company is performing. He wants to know how much return you will give it to him, etc. Right? There's so much of chaos and so much of confusion here with the absence of financial market. But thanks to financial market, we have easy access. Now, the investor can easily look into the performance of the company because of the financial statements that you provide, your financial documents, that is your balance sheet, cash flow statement, profit and loss account, everything is published, right? Once the company at the end of financial year gets its documents audited, it has to publish its documents on its company website or even create an annual report magazine. Correct? Now this will be reached by the investor. So investor can assess your performance and then start investing money into it. You understand? So financial markets is a great platform for both companies to reach out to investors and investors to reach out to the businessmen or business investment opportunities. Moving on to the last point of the features or characteristics, reduction in transaction cost and provision for the information. The trader requires various types of information while doing the transaction of what? Buying and selling of the securities. The financial markets helps in providing every type of information to the traders without the requirement of spending money by them. In this way, the market reduces the cost of transaction. Now today, because of information technology, we have access of everything, correct? Now before technology or before everything, this entire system came up, it was so difficult for any information to pass on to people, correct? Any information to spread out to people. But today, thanks to technology, with a click away, we can get to know what is happening on the other side of the globe, correct? What is happening on the other side of the globe, at the click away we have the news on our phones, correct? So here in the same manner, our financial markets, right, it is not so easy to make a decision whether to buy or whether to sell a particular share, particular bond in a particular market. But thanks to the information that the markets provide to us without spending much money, because everything is reflected into the increase in shares prices or decrease in share prices immediately. If you can observe, before this Mr. Trump was elected as a US president, right, when the previous time presidential elections were coming up, just on that particular day of election itself, okay, when the president will be nominated and elected, if you would go back and observe the stock markets in India, it had a great impact, okay? Somewhere, some other country, that is the US country, is having presidential elections, and that election's impact is being shown in our stock market share price fluctuation. Why is it so? Because once who is the person coming to the power will determine the trade or economic relationship that US will have with India, US will have with Germany, etc. It all depends on what? The person who is coming to the power, and what kind of decisions would that person make which will affect our trade relationships with them or our economic relationship with them. So it quickly reflected in our stock market. So investors, as you and me, do not have to worry about the information. Information is plenty, and it is only up to us to make the right choices when to invest and when to sell, when to purchase a particular asset or an instrument, or when to sell. How will this impact? It will reduce my transaction cost. I do not have to spend much money in knowing the knowledge or in knowing the information. It is automatically reflected in the markets, and thereby it will reduce my transaction cost. Understood? So these are the 8 different features of financial markets. So we learnt what is a financial market. We learned the features. First one, it acts as a link. It determines the price. It enables easy liquidity. It enables sharing of risk across. It enables to formation of capital, easy access, and reduction in transaction cost and provision of the information.